Warren Buffett is worth over $130 billion. He's been called the greatest investor of all time. But here's the thing most people never talk about. He's also made some of the most expensive mistakes in investment history. And what separates Buffett from everyone else isn't just that he wins big. It's that when he loses loudly, admits it publicly, and teaches the rest of us exactly what went wrong. Today, we're going inside 5 of Warren Buffett's biggest investment mistakes, the ones that cost him billions, and more importantly, we're breaking down the lessons that came out of each one, because those lessons are worth far more than the money he lost. Let's get into it. Here's an irony that even Buffett laughs about today. The single company he's most associated with, Berkshire Hathaway, was itself one of his worst investments. Back in 1962, Buffett started buying shares in Berkshire, which was a struggling New England textile company. The stock was cheap, and that fit the strategy he learned from his mentor Benjamin Graham: buy beaten down, cheap companies and wait for a rebound. But then something personal got in the way. Seabury Stanton, the CEO of Berkshire at the time, had verbally agreed to buy back Buffett's shares at $11.50. When the tender offer came in writing, at $11.375, Buffett was furious. He called it a double cross. And in a moment of pure emotion, instead of selling, he bought more shares, took over the company, and fired Stanton. He won the battle. But he lost the war. Buffett later admitted that this single emotional, revenge-driven decision cost him roughly $200 billion in compounded value, because instead of deploying that capital into great businesses, he spent decades trying to rescue a dying textile company before finally converting Berkshire into a holding company. He called it, quote, "the dumbest stock I ever bought." The lesson: never let emotion drive investment decisions. Ego and pride are among the most expensive luxuries an investor can afford. Buffett's rule: stick to the business fundamentals, not the personal feelings. In 1993, Warren Buffett acquired Dexter Shoe Company for approximately $433 million. On the surface, it seemed like a smart deal. Dexter was profitable, made quality shoes in the US, had strong brand loyalty, and seemed to have a competitive moat. But Buffett made 2 critical errors here. First, he misjudged the durability of the competitive advantage. Within just a few years of the acquisition, cheap imports from overseas, particularly from Asia, destroyed Dexter's pricing power. The moat, he thought he saw, evaporated almost overnight. Dexter couldn't compete on price, and the business deteriorated rapidly. But that wasn't even the worst part. Buffett didn't pay cash for Dexter. He paid in Berkshire Hathaway stock. He issued shares valued at $433 million at the time. But those shares, had they simply been held, would have grown to over $8 billion by the time he publicly acknowledged the mistake in his 2007 shareholder letter. He described Dexter as, in his own words, "the worst deal I've ever made." The lesson: 2 things here. 1. A moat must be durable, not just currently visible. Cheap labor and global competition are real threats that can erode an advantage fast. 2. Paying with overvalued stock can be smart, but paying with undervalued stock is extraordinarily expensive. Know what you're giving away when you write that check. In 1989, Warren Buffett invested $358 million in US Airways preferred stock. This one is particularly interesting because Buffett knew he was going against his own principles when he made it. He had said for years that the airline industry was a death trap for investors, that the combination of high fixed costs, brutal competition, price-sensitive customers, and powerful labor unions made it nearly impossible to generate consistent returns. And yet, he did it anyway. Why? Largely because the preferred stock came with attractive dividend terms and seemed to offer downside protection. The business logic looked compelling in isolation. But the broader airline industry economics couldn't be wished away. US Airways ran into severe financial trouble. The dividend was suspended. The stock Buffett held dropped dramatically in value. For a period of time, he publicly described the investment as probably worthless. Eventually, he got out roughly at break-even, but only after years of stress, uncertainty, and opportunity cost. What makes this mistake so valuable is that Buffett violated something he calls his circle of competence. He understood great businesses, consumer brands, insurance, financials. He did not deeply understand the structural economics of the airline industry. And he paid the price for stepping outside his lane. The lesson: knowing what you don't know is just as important as knowing what you do. Your circle of competence isn't a limitation, it's your edge. The moment you step outside it because a deal looks superficially attractive, you're gambling, not investing. This one cost Berkshire roughly $873 million, and Buffett called it a mistake that he made without consulting Charlie, referring to his longtime partner Charlie Munger. In 2007, Buffett bought approximately $2 billion worth of bonds in Energy Future Holdings, a Texas utility company that had been taken private in what was, at that time, the largest leveraged buyout in history. The investment thesis was straightforward: natural gas prices were high, making coal-fired electricity generation look competitive. EFH owned a massive network of coal plants in Texas. If gas prices stayed high, coal would remain cheap by comparison, and EFH would be very profitable. The problem? Natural gas prices collapsed. The shale revolution transformed the US energy market. Suddenly, natural gas was cheap and abundant, which made EFH's coal plants largely uneconomical. The company declared bankruptcy in 2014. Berkshire eventually took a write-down of around $873 million. Buffett later admitted the key error: he had essentially made a macro bet on commodity prices, something he almost never does and almost never should do. He thought he understood the direction of natural gas prices. He didn't. Nobody did. The lesson: predicting commodity prices is a loser's game, even for the best. Buffett's entire philosophy is to invest in businesses with durable, price-independent competitive advantages, brands, networks, cost structures. The moment you anchor an investment thesis to a macro commodity call, you've introduced a variable you can't control. Now we get to what might be the most instructive category of Buffett mistake: not something he bought and lost money on, but something he watched grow from the sidelines and did nothing about. Buffett has publicly admitted that he failed to buy both Google and Amazon when he had every reason to. With Google, Berkshire was already a major shareholder in Geico, one of Google's largest early advertising customers. Buffett had front-row access to how transformational Google's advertising business was. He watched Geico's returns on its Google ad spend and could see exactly how powerful the platform was. And yet, he didn't buy. With Amazon, Buffett has said he admired Jeff Bezos enormously for years. He watched Amazon systematically disrupt industry after industry. He has since called Bezos the most remarkable businessman he's ever seen. And yet, he didn't buy that either. His explanation for both? He understood what these companies were doing, but he didn't believe he could accurately value them using his traditional frameworks. Amazon, in particular, was reinvesting almost all its cash flow for years, making it nearly impossible to apply a traditional earnings-based valuation. He admits this was a failure of imagination and adaptability. He stayed too rigidly inside the mental models that had worked for him in manufacturing, insurance, and consumer goods, and missed the software and platform economy almost entirely. The lesson: your investment frameworks must evolve. Buffett eventually adapted. Berkshire has now owned Apple since 2016, which became one of its most profitable positions ever. The lesson isn't buy every tech stock. The lesson is that if you can understand a business, the framework for evaluating it shouldn't be a rigid wall that keeps you out. Learn to value new types of businesses, or partner with people who can. So what's the through line across all 5 of these mistakes? 1. Emotions and ego are expensive. Don't let pride drive the buy or the hold. 2. Every moat has a shelf life. Always ask, can this advantage be destroyed in 10 years? 3. Stay in your circle of competence. Step outside it only when you've done the real work of understanding. 4. Don't bet on commodity prices or macro variables. Invest in businesses that win regardless of what the market does. And 5. Frameworks must evolve. The world changes. The best investors adapt. The reason Warren Buffett is still considered the greatest of all time isn't because he's never wrong. It's because every time he's wrong, he says so, studies it, and gets better because of it. That's not just investing wisdom. That's a philosophy for life. If you found this valuable, make sure you subscribe. We go deep on value investing, Buffett, and the mental models that build real wealth. Drop a comment below. Which of these 5 mistakes surprised you the most? And I'll see you in the next one.